Well, folks, gather around for a tale of corporate woe, a story so shocking it almost makes you forget about that sentient AI toaster trying to unionize. Yesterday, June 5th, 2025, was quite the day for Tesla, the electric car company run by the internet's favorite and sometimes least favorite billionaire. The company's stock, you see, decided to take a bit of a nosedive, and by nosedive I mean it plummeted a staggering 14%. Yes, you heard that right, 14%. The stock closed at a rather sad $284.70. That was a drop of $47.23 in a single chaotic day of trading. It's the kind of drop that makes grown investors weep into their kale smoothies. Now, a 14% drop in stock price might sound like just a number to some, but when you're talking about a behemoth like Tesla, that percentage translates into an absolutely eye-watering amount of money. We're talking about over $150 billion wiped off its market value. $150 billion. Poof! Gone. Vanished into the ether like a politician's promise. That's more money than many small countries have. This wasn't just a dip, it was a financial crater, a stark reminder that what goes up, especially when fueled by hype and personality, can come down with a very expensive thud indeed. The trading day itself was, to put it mildly, a roller coaster designed by a sadist. Tesla's stock opened at $322.21, full of morning optimism, or perhaps just blissful ignorance of the impending doom. But things quickly went south. The price bounced around between a low of $273.60 and a high of $329.89 before finally settling at that grim closing figure. And get this, a whopping 292.8 million shares were traded. That's a lot of people hitting the panic button, a digital stampede of investors desperately trying to get out before things got even worse. It was less buy the dip and more flee the abyss. And let's be clear, this wasn't some bolt from the blue for an otherwise soaring stock. Oh no. Tesla's shares have been having a bit of a rough year. Since the start of 2025, the stock is down about 30%. So, this massive plunge on June 5th wasn't an isolated incident. It was more like a particularly violent lurch downwards on an already bumpy ride. It seems the shine might be coming off the chrome, or perhaps the battery is just running a bit low on investor confidence. You know, just a tiny bit. Like a continental shelf-sized tiny bit. So, what caused this financial earthquake, this sudden investor exodus? Well, the primary culprit, it seems, was a good old-fashioned public feud, but not just any feud. This was a clash of titans, a battle of gargantuan egos, Tesla CEO Elon Musk versus President Donald Trump. Yes, the architect of self-driving cars locking horns with the architect of, well, many interesting tweets. It's the kind of heavyweight bout that usually only happens in celebrity boxing matches, but this time, the collateral damage was measured in billions of dollars of shareholder value. It's almost like having two toddlers fighting over a very, very expensive toy. The spark that ignited this inferno, the casus belli if you're feeling fancy, was Musk's criticism of a GOP tax bill. Now, politicians proposing bills is hardly news. But this particular bill had a little something special in it, a proposal to eliminate electric vehicle incentives. Musk, whose company rather enjoys those incentives, decided to speak out against it. He probably thought he was just exercising his civic duty, or maybe he just couldn't resist a good Twitter debate. Whatever the reason, taking a public swing at a policy favored by the president turned out to be, shall we say, a bold move. President Trump, not exactly known for his thick skin or his love of being contradicted, responded with characteristic subtlety. Just kidding, he went full Trump. He threatened to cut Tesla's government subsidies and contracts. He even mused publicly about terminating them entirely, to save the taxpayers billions. It was a direct, unambiguous threat to Tesla's bottom line, essentially saying, "Nice government contracts you've got there. Shame if something were to happen to them." This is what happens when business strategy meets playground politics. It's not pretty, and it's certainly not cheap for investors. Unsurprisingly, this public spat sent shivers down the spines of investors. They started to fret, and understandably so, about the potential for serious regulatory setbacks and significant financial risks for Tesla. The company relies on a somewhat friendly regulatory environment, especially for things like its autonomous vehicle ambitions. When the president himself is making noises about pulling the plug on your government support, it doesn't exactly inspire confidence. It's like finding out your landlord is also your arch nemesis, and he's just remembered you're 3 months behind on rent. The investor anxiety wasn't just vague, general nervousness. Oh no, there were very specific, very pointy regulatory daggers being waved in Tesla's direction. That aforementioned GOP tax bill, for instance, wasn't just talking about any old EV incentive. It was targeting the rather juicy $7,500 federal tax credit that buyers get for purchasing an electric vehicle. The bill proposed to eliminate this subsidy by the end of 2025, a full 7 years earlier than previously planned. And guess what? All Tesla vehicles sold in the US currently qualify for this subsidy. Pulling that rug out early would be a significant blow to demand. Then there's the whole autonomous vehicle situation. Tesla, as you know, is betting big on self-driving cars and its full self-driving software. But, and it's a big but, the US Transportation Department, specifically the National Highway Traffic Safety Administration, NHTSA, gets to say what's safe and what's not. There's already an ongoing NHTSA investigation into Tesla's full self-driving software following a rather unfortunate fatal crash. Now add to that the fear that new federal rules, perhaps influenced by, say, a disgruntled president, could suddenly disadvantage Tesla. For example, what if they mandated LiDAR technology, a sensor Musk famously derides and Tesla doesn't use? That would be awkward. And the potential pain doesn't stop there. President Trump's ire, once provoked, isn't known for its precision. His threats could easily spill over and impact Musk's other high-profile ventures, particularly SpaceX, which relies heavily on government contracts. Imagine NASA suddenly finding alternative providers for its rocket needs. Furthermore, there's the possibility that Tesla could be excluded from selling emissions credits. These credits, which Tesla sells to other automakers who don't meet emission standards, are a surprisingly significant source of pure profit for the company. Losing that would be like finding a hole in your piggy bank. A very large, politically motivated hole. The financial implications of all this are, frankly, terrifying for Tesla. Beyond the immediate stock market carnage, analysts are already calculating the potential hit to actual profits. One report suggests Tesla could face a $1.2 billion blow to its annual profit. And that's not all. An additional $2 billion setback could come from the loss of regulatory credit sales, thanks to separate Senate legislation targeting California's EV sales mandates. We're talking billions here, folks. Billions with a B. It's enough to make even a billionaire CEO sweat a little, or at least tweet something cryptic about it. Now, if the feud with the president and lurking regulatory nightmares weren't enough, Tesla is also juggling a few other rather heavy balls. The company is facing the delightful problem of declining sales in key markets. Yes, in places like China and Europe, which were supposed to be big growth areas, demand seems to be cooling off. This isn't just a minor blip, it's a worrying trend that suggests deeper issues than just a grumpy politician. And while Tesla is trying to sell cars, competition is heating up. Companies like BYD in China are nipping at Tesla's heels, offering compelling alternatives, often at lower prices. And then there are the internal dramas, because of course there are. Tesla seems to have a permanent subscription to controversy. There are ongoing legal issues which are always a drain on resources and reputation. Plus there's the public backlash against some of Elon Musk's more, shall we say, outspoken political activities and pronouncements. It turns out not everyone enjoys their car CEO also being a part-time internet flamethrower. Adding to the general sense of unease, Musk also recently stepped down from his role as head of the Department of Government Efficiency. Quite the title and quite the convenient exit, some might say. So with all this chaos, what do the people who supposedly understand these things, the analysts, think? Well, it's a mixed bag as always. Some remain stubbornly optimistic. Wedbush analysts, for example, are still looking at the long-term picture. They see Tesla's advancements in artificial intelligence and autonomous vehicles as potentially unlocking a market value of, wait for it, $1 trillion. Yes, $1 trillion. That's a lot of optimism, especially when the current picture looks more like a dumpster fire. They believe the AI and autonomous driving opportunities are the real long-term story here. However, not everyone is drinking the optimist Kool-Aid. A Morningstar analyst, for instance, expressed serious concerns about those regulatory risks we talked about and the potential for personal retaliation from President Trump. Interactive Brokers chimed in, noting that the political winds have clearly turned against Tesla. And Crossmark Global Investments voiced good old-fashioned skepticism about Tesla's sky-high valuation and its underlying fundamentals. Interestingly, despite the massive sell-off, some analysts, like those at Morningstar, maintain a fair value estimate of $250 per share for Tesla, suggesting the stock is now fairly valued after its tumble. Tesla is still, by a long shot, the most valuable automaker worldwide, but the path ahead, with an upcoming robotaxi test on June 12th, looks incredibly challenging. It seems the future will depend less on subsidies and more on actual consumer demand, and whether Tesla can navigate this perfect storm. Good luck with that.